Welcome to the debate. Today we're dissecting a friction point that is rapidly redefining the financial world, the integration of large language models, specifically something like GPT-4, into trading strategies. We're really looking at a collision between, I guess, the dream of a perfectly efficient market and the nightmare of a system that's just too tightly wound.
It really is that classic tension, isn't it? Speed versus survival. The core question we're wrestling with is, does the superhuman processing speed of AI create a market that finally reflects truth? Or are we maybe inadvertently building a kind of doomsday machine that's susceptible to just catastrophic, instantaneous collapse?
I'm arguing that AI is the ultimate tool for price discovery. We finally have the technology to solve these deep market inefficiencies, specifically something called post-announcement drift, by analyzing information faster and, frankly, more deeply than is humanly possible. This is about removing friction.
And I'm here to argue that while the profits are real, and they are very real, they are being purchased at the cost of systemic fragility. When you replace diverse, messy human decision-making with synchronized, high-speed algorithms, you aren't just making the market faster, you are making it brittle. You are setting the stage for a crash we might not be able to stop.
So I want to start by just framing this opportunity, because I think the fear narrative often overshadows just how incredibly inefficient our current markets actually are. We operate under this, academic assumption, the efficient market hypothesis, the idea that stock prices instantly reflect all available information. A company releases a report, the price moves. That's the theory.
And it's a theory that's, it's held water for decades.
Theoretically, yes. But the recent research we're looking at, specifically this extensive work by Lopez-Lira and Tang, proves that's just, it's not true in practice. Markets are surprisingly, almost painfully slow. They're clogged with what the paper calls information processing frictions. And let's be honest about what that really means. It means humans are slow.
I don't dispute that humans have limits. We need sleep, we need coffee, and we physically cannot read 1,000 pages a second.
Right, but it's more than just reading speed. It's this idea of bounded rationality. Even the smartest trader on Wall Street has a cognitive limit. They can't read every headline, every press release, every footnote the moment it hits the wire. And because of this, we see this phenomenon called drift. So good news hits, the stock jumps a little, but then it keeps drifting upward for days as humans slowly catch up, digest the news, and place their trades. That drift is inefficiency. But more importantly, from my perspective, that drift is free money.
Free money? That is a dangerous phrase in finance.
But it is. It's money left on the table because the human brain is too slow to pick it up. The Lopez-Lira data on GPT-4 is absolutely staggering in this regard. They found that a strategy using GPT-4 to interpret headlines and then trade on this drift, it generates an annualized Sharpe ratio of nearly 3.0, specifically 2.97.
Okay, so for the listeners who don't spend their days staring at Bloomberg terminals, we should probably pause on that number. A Sharpe ratio, it basically measures your risk-adjusted return. How much money are you making relative to let's say, the bumpiness of the ride?
Exactly. And to give you some context, a Sharpe ratio of 1 is considered good for a hedge fund. 2 is exceptional. That's, legendary status. A ratio of 3, that is sophisticated arbitrage territory. That's usually reserved for high-frequency trading firms with their own microwave towers. But this isn't that. This is off-the-shelf AI reading the news without any specific financial training and understanding the economic implications better than the marginal human trader.
So it's reading the news, understanding it, and placing a bet on it before most humans have even finished reading the headline.
Precisely. It buys stocks with positive news and it shorts those with negative news, correcting the price almost immediately. It is effectively stealing that profit from the slow human traders who would have bought it 3 days later. It's doing what the market is supposed to do, finding the true price, just faster than we ever thought possible.
I grant you the numbers are impressive. A Sharpe of 3 is hard to argue with on a balance sheet. But I just don't buy that faster automatically equals better in a systemic sense. I'm looking at this through the lens of what's called normal accident theory, as articulated by researchers like Min and Borch. They argue that financial markets are a tightly coupled system.
Tight coupling? That's a term from engineering, isn't it? Like in nuclear plants?
Exactly. So imagine a line of dominoes. If they're spaced far apart, that's loose coupling. If one falls, you have time to see it, react, and, grab the next one before it tips over. You have a buffer. Tight coupling is when the dominoes are basically leaning against each other. One falls and the whole row is down before you can even blink. When you introduce agents like GPT-4 that operate at speeds beyond human cognition, you're removing the spacing between those dominoes. You're removing the slack.
Slack just sounds like a euphemism for inefficiency to me. You're defending the right to be slow.
Look, I am defending the right to survive. Slack is the buffer. It is the time required to stop an error before it becomes a disaster. We have seen what happens when you remove it. Just look at the cautionary tale of Knight Capital back in 2012. This is an ancient history. They deployed a piece of code that malfunctioned. Because the system was so tightly coupled and automated, it executed millions of erroneous orders in minutes.
They lost a lot of money. I remember that.
They lost over $460 million in 45 minutes. Think about the velocity of that failure. That's over $10 million disappearing every single minute. And that is the definition of a normal accident in a high-tech system. It's not some freak occurrence. It's an inevitability of the system's design. When these things fail, they don't fail gracefully. They fail catastrophically and instantly. The drift you are so eager to eliminate, that human slowness, is actually a safety valve. It represents the diversity of human reaction times. You remove it, you create a market that is hyper-efficient right up until the moment it shatters.
I'm not convinced by that comparison because you're conflating, I think, dumb execution algorithms with smart information processing. Knight Capital was a deployment error of a rote execution script. It was basically a buy button getting stuck on repeat. What we are seeing with GPT-4 is a massive leap in sophistication. This brings me to the mechanism of profit versus your mechanism of collapse. The Lopez-Lira research digs into where GPT-4 makes its money. And it isn't just, front-running Apple or Google earnings where everyone is watching.
Right. The efficient parts of the market are already totally saturated.
Exactly. The most significant predictive power is found in smaller stocks, small caps, and crucially, in interpreting bad news for short positions. These are the corners of the market that human traders often just neglect.
Which are also exactly the areas where liquidity, the ability to buy and sell easily, is often the thinnest.
But that's the point. Sophisticated human traders often ignore small caps because the information acquisition costs are just too high. It's not worth a hedge fund manager's time to read a complex 50-page clinical trial report for a tiny biotech firm worth $50 million. So the price lags and just sits there, wrong for days.
So the humans are ignoring it, leaving the price stagnant.
Precisely. And GPT-4 exploits this gap. It identifies the fundamental value immediately. If the clinical trial failed, the AI knows the stock is worth zero now, not next week. It corrects these information processing frictions. Why should we allow a stock to trade at an inflated price for 3 days just because humans are too slow or too lazy to read the report? The AI is doing the market a service by brutally correcting that price to where it belongs.
Because if 10 million instances of GPT-4 read that same report and decide the value is zero in the same millisecond, you don't get a price correction, you get a liquidity black hole.
A black hole? That sounds a bit dramatic.
It's accurate. You're describing a synchronization of behavior that is incredibly dangerous. We saw a preview of this with the flash crash of May 2010. And that wasn't even AI as we know it today. That was just high-frequency algorithms reacting to a large sell order in E-mini futures.
That was a feedback loop of execution algos, though. It wasn't semantic analysis of news. It was numbers reacting to numbers.
But it's the same structural dynamic. The algorithms monitoring the electronic order book reacted nonlinearly. One large sell order triggered a feedback loop where the algos just interpreted the selling as a signal to sell more. Now imagine that same dynamic, but driven by a semantic understanding of news.
Okay, walk me through that scenario. How does reading the news cause a crash?
Okay. So imagine a headline breaks. Regulatory investigation open into company X. Humans might read that and say, Is this serious? Let's call the investor relations department. Let's wait for a statement. There's a heterogeneity in the reaction. Some sell, some hold, some wait. But if GPT-4 models all read that headline, interpret it as catastrophic, and they all hit the bid simultaneously, who's on the other side of that trade?
The market makers?
The market maker algorithms, which are also automated, will see this wave of selling and they'll pull their quotes to protect themselves. They vanish. The correction you celebrate becomes a rout. The price doesn't go to its fundamental value, it goes to a penny in a fraction of a second. The exit door is painted on the wall. And when everyone rushes for it at the exact same light speed instant, nobody gets out.
That's a vivid image, though. I would frame it differently. You're assuming all these AI models are identical and will act in unison like a hive mind. But the research shows a fascinating threshold effect. This isn't a monolith.
What do you mean by a threshold effect?
Lopez-Lira and Tang found that the smaller models, like GPT-1, GPT-2, even BERT, which was the industry standard for a long time, they cannot generate these profits. They fall below this quality threshold, or K. They just generate noise. It's only when you get to the sophistication of GPT-4 that you see this 2.97 Sharpe ratio. This implies that as models get smarter, they get better at distinguishing signal from noise. They aren't just reacting to scary words, they are performing complex synthesis.
Complex synthesis sounds impressive. But have you considered the risk of complex hallucination?
Let me finish the thought on synthesis because it's key to safety. The research shows the biggest advantage for GPT-4 over GPT-3.5 is in categories like insider stock transactions and healthcare presentations. These are nuanced texts. A dumb algorithm might see an insider selling stock and just panic. GPT-4 can read the filing and see it's a scheduled tax sale, not a vote of no confidence. That reduces the likelihood of the erroneous feedback loops you fear. It brings rationality to the market's speed. It's actually smarter than the knee-jerk human reaction.
I challenge the idea that smarter models are inherently safer for the system. In fact, I'd argue the threshold effect actually makes the tight coupling worse.
How so? Better intelligence usually means better decisions.
Well, if only the most advanced models, let's say GPT-4 and its peers, are capable of this profitable interpretation, then every serious trading firm is going to converge on those specific models. You effectively homogenize the market's brain, and this leads to the obsessance of the signal. If everyone adopts the threshold-level technology, the information advantage vanishes.
That is how markets become efficient, though. The gap closes. That's a feature, not a bug.
But look at the mechanism. If everyone sees the signal, then everyone races to be the first millisecond. You aren't eliminating the race, you were just compressing it. And regarding your point on synthesis, what happens when the model gets it wrong? AI models are prone to hallucinations, to misinterpretations of nuance. If a smart model misinterprets a complex headline about a healthcare merger, maybe it understands the sarcasm in a CEO statement as literal fact. That error isn't checked by a human. It's propagated at light speed. And because you've argued these models are so good at complex synthesis, traders will trust them more than the old algorithms. That overconfidence is a classic precursor to a normal accident.
I see the risk you are pointing at, the risk of the mono-model market, where everyone thinks the same thought at the same time. But I believe you are underestimating the capacity for engineering controls. I mean, we aren't just releasing these bots into the wild without guardrails. This brings us to the concept of high-reliability organizations, or HROs, which Min and Borch discuss.
HROs. Those are usually things like nuclear power plants or air traffic control, right? Systems where failure is just not an option.
Exactly. The financial industry isn't ignorant of these risks. Firms implement kill switches, circuit breakers, and rigorous backtesting. They know the stakes.
Those are standard defenses, yes.
So we can engineer our way to stability. If an AI starts trading erratically, risk parameters catch it. If volatility spikes, circuit breakers pause the exchange. We can have the efficiency of GPT-4 with the safety of HRO principles embedded in the code. The Lopez-Lira paper even suggests that as inattentive agents, think retail investors, adopt these LLMs, they become empowered. They close the gap with institutional investors. It's a democratization of high-quality information. That diversity of users, all using AI to check their blind spots, actually creates a more robust market, not a fragile one.
That is a compelling argument, and I want to believe it. But it walks right into the trap of what's called the paradox of reliability.
The paradox of reliability? That sounds like a riddle.
It's the most counterintuitive yet crucial finding in the Min and Borch research. They argue that rational safety measures implemented for a single firm can actually cause a systemic crash.
How can being safe cause a crash? That doesn't make any sense. If I drive safely, the road is safer.
In traffic, yes. In markets, no. Think about feed-driven integrity pauses or even simple stop-loss orders. So let's say there's a momentary data glitch or a sudden price dip. A prudent, high-reliability firm has programmed their AI to pause trading or sell to limit losses when that happens. That makes perfect sense for that firm, right?
Sure, protect the capital. Don't catch a falling knife.
But in a tightly coupled market, if every single AI is programmed to be prudent in the exact same way, they all pause or sell simultaneously.
Ah, I see where you're going. The liquidity drain again.
Precisely. When everyone acts safely by pulling back, they collectively drain all liquidity from the market. The bid side just evaporates into thin air. The crash happens because of the safety protocols, not in spite of them. You cannot engineer your way out of tight coupling when the actors are independent but reacting to the same data. The kill switch for one firm is the trigger for the next firm's panic. And this is why Min and Borch emphasize that you cannot view these organizations in isolation. The system itself has properties that individual reliability just cannot fix.
I admit the synchronization of risk controls is a valid concern. It's a tragedy of the commons, in a way. However, I look at the data, and I see a trajectory toward better understanding. The annualized Sharpe ratio of nearly 3 from the Lopez-Lira study isn't just a number. It is proof that the machine understands economic reality better than the marginal human trader. And that marginal trader is emotional, slow, and often wrong.
But the marginal trader adds noise, and noise is diversity. Diversity is resilience. When everyone is wrong in different ways, the market is stable. When everyone is right in the same way at the same time, the market is a bomb.
But noise is inefficiency. By replacing that noise with signal, we are entering an era of augmented intelligence. We aren't replacing humans entirely, we are giving them a tool that filters the noise. The decline in Sharpe ratios that Lopez-Lira observed in later periods suggests the market is already adapting, already becoming more efficient. The easy money is disappearing because the information is being incorporated faster. That is the definition of a healthy market. We are smoothing out the frictions that have plagued price discovery for decades. We shouldn't fear the speed, we should welcome the clarity.
But clarity at what cost? That is the question I keep coming back to. I'd summarize it this way. The profits are statistically significant, yes, but they are accrued by increasing the systemic fragility. We are building a market that is perfect right up until the moment it shatters. You cannot effectively manage a system that operates faster than human cognition can possibly intervene. The paradox of reliability shows us that our very attempts to make the system safe might be the triggers for the next collapse. We're trading resilience for optimization. And in a complex system like the global economy, resilience should always be the priority.
And I would argue that true resilience comes from accurate pricing, not from the artificial buffer of ignorance or slowness. The transition will be bumpy, there's no doubt about that. But the destination, a market that instantly and accurately values assets based on all available human knowledge, is worth the engineering challenges.
It seems we are at an impasse between the promise of the perfect price and the peril of the perfect storm.
Indeed, it's the defining economic trade-off of the AI era. Do we want a market that is fast and right, or slow and safe?
And it's one that every investor, regulator, and algorithm developer needs to weigh very, very carefully before they flip that switch. Because once the switch is flipped, there's no calling the trade back.
Thank you for listening to The Debate. We hope this exchange has illuminated the mechanisms driving your portfolio, for better or for worse.
Until next time.